Time for your daily dose of automotive news. Grab your coffee, tea, or whatever snack gets you going, and let's dive into what's driving the world today.
1 in 4 people walking into a dealership right now to trade in their car is already underwater on their loan. Think about that. A quarter of all drivers owe more on their vehicles than those cars are even worth. The average gap? Around $6,700. And for thousands of buyers, it's not just a small problem, it's a financial hole more than $15,000 deep. CarMax, the biggest used car dealer in America, has seen this storm forming. And the moves they're making right now tell us something ugly is on the horizon. Because when the largest player in the market starts bracing for disaster, you know the rest of the industry is in serious trouble. So let's break down what's really happening in the car market, why dealers and banks are panicking, and how this whole cycle of debt could implode sooner than anyone expects. Negative equity isn't new. It simply means you owe more than your car is worth. It's happened for decades. But here's the problem. The scale today is unlike anything the market has ever seen. In the past, if someone traded in a car with a few thousand still owed, dealerships had tricks. They'd roll over the balance into the next loan, or they'd write up a lease that buried the extra debt into the monthly payment. It wasn't great for the buyer, but it kept the system moving. Now, that trick doesn't work anymore. Not when people are showing up with $10,000 of negative equity. Dealers can't hide that kind of loss inside a new contract. Banks won't touch it, and consumers, most of whom don't even have $500 in savings for an emergency, certainly can't write a check to cover it. That's where the cycle breaks. These buyers aren't just in a bad deal. They're locked out of the market entirely. And when a quarter of all customers suddenly can't trade in, the whole machine starts seizing up. But the most alarming warning isn't coming from small-town dealers. It's coming from a giant. CarMax sells more used cars than anyone else in the US. They've got the money, the data, and the reach to spot trouble before the average person ever feels it. And what are they doing right now? Quietly stockpiling billions in loan loss reserves. That's Wall Street language for one thing. They're preparing for people to stop making their car payments. Reports show CarMax has dramatically increased the amount of cash they're setting aside to cover bad loans. They know a wave of repossessions is coming. And if even a giant like CarMax, with every advantage in the market, is bracing for defaults, imagine the pain that's about to hit the smaller dealerships, the regional banks, and the buyers stuck in the middle. This isn't just a company tightening its belt. It's the largest used car retailer in America, sending up a flare. And when the market leader says, "Get ready for people to stop paying," it's a sign the storm is already here. But the problem goes deeper than just repossessions. It's the crushing weight of payments that millions of people are already locked into. Here's where it gets insane. The average monthly payment on a new car in 2025, roughly $700, already outrageous. But for buyers rolling over negative equity into their next loan, that number jumps to more than $900 a month. That's not just a car payment. It's a mortgage in some parts of the country. And it's being carried by families who statistically don't even have $1,000 in savings. And it's not just the monthly bill. On average, these buyers are paying $12,000 more for the next car compared to their last one. So they're not trading down to something more affordable. They're upgrading, digging themselves into an even deeper hole because they want to keep up appearances. It's the classic keeping up with the Joneses trap. Except this time, it's not about showing off a new ride. It's about strapping yourself to a financial time bomb that's guaranteed to go off in the next 3 to 5 years. And when that happens, the wave won't just wipe out buyers, it'll crash directly into the lenders. Cars don't last forever. 3, 4, maybe 5 years down the road, something breaks. A transmission, an engine, even just expensive electronics. And when the repair bill hits, these owners face an impossible choice. Pay thousands of dollars to fix a car they already owe too much on, or walk away and let it get repossessed. Industry insiders are already whispering about a looming repo crisis. Banks and lenders are bracing for it. And reports claim this could echo the subprime mortgage collapse of 2008, except this time it's focused on auto loans. Rumors suggest some lenders are lobbying regulators for relief, fearing a meltdown in the auto finance sector. Because if default rates spike the way analysts predict, repossessions could hit record highs. But the scary part, the crisis doesn't just crush car owners and lenders. It infects the entire ecosystem. Here's how the car market actually works. New car dealers rely on trade-ins. Those trade-ins go to wholesale auctions. Used car dealers buy from those auctions. Simple system. But when 25% of buyers can't trade in, the supply chain collapses. Fewer trade-ins mean fewer cars at auction. That drives wholesale prices up and lowers the quality of the inventory that smaller dealers can buy. For independent dealers, especially those selling $5,000 and under vehicles, it's devastating. Dealers are already reporting shortages of affordable used cars, with wholesale prices climbing even as demand falls. And when small dealers can't restock, it's not just their business that suffers, it's the entire second-hand market that millions of working-class families depend on. And remember, these are the very people who can least afford a financial shock. This car debt crisis doesn't exist in isolation. It's part of a bigger storm, America's household debt. Credit card delinquencies are climbing to highs not seen in over a decade. Personal loans are defaulting at faster rates, and auto loans, traditionally one of the most stable forms of debt, are suddenly on shaky ground. How did we get here? Over the last 5 years, prices skyrocketed. Supply chain issues, inflation, and pandemic shortages pushed car prices into the stratosphere. Instead of saying no, consumers said yes, by any means necessary. They stretched loan terms to absurd lengths, in some cases up to 9 years. Think about that. A 9-year car loan. That's longer than most people even keep the same vehicle. Longer than the average marriage in the US. And now those stretched loans are coming back to haunt the market. Reports claim that banks are tracking rising defaults closely, while investors are comparing the situation to a mini subprime auto bubble. But what happens when the bubble bursts? Here's the nightmare scenario. 3 years from now, today's underwater buyers go to trade in again. But this time, instead of being $7,000 or $10,000 underwater, they're $20,000 upside down. No dealer is going to roll that over, no bank is going to approve it. At that point, millions of Americans will simply be locked out of the car market. And when that cycle of trade-in, auction, resale collapses, the entire industry feels it. Automakers sell fewer new cars. Dealers can't move inventory. Banks eat losses on defaults. And working-class families are left scrambling for affordable transportation that no longer exists. This isn't just a car problem anymore, it's an economy problem. So here's where we stand. 1 in 4 car owners is underwater on their loan. Average payments are spiraling toward $900 a month. Dealers like CarMax are bracing for repossessions. And the trade-in system that fuels the entire market is starting to break. The question is simple. How long can this debt cycle keep spinning before it snaps? Because at some point, the math doesn't work. And when it doesn't, the repo lots will overflow, the auctions will dry up, and the dream of effortless car ownership every 3 years will vanish. Maybe the real lesson isn't about cars at all. Maybe it's about a culture that's addicted to debt. A system that tells people they can finance their way to wealth while quietly chaining them to liabilities that only lose value. And maybe the smartest move you can make right now is to step off the merry-go-round before it crashes. If this video opened your eyes about what's really happening in the car market, hit that like button and share your thoughts in the comments. Have you or someone you know ever dealt with car loan trouble? And don't forget to subscribe, because we've got more surprising stories coming.